again with another video, but before we start, I'd like to begin with a quote, this time from Benjamin Franklin. Benjamin Franklin was one of the founding fathers of the United States, and he was a pioneer of investing, so his words should be very relevant to what we're learning today. Benjamin Franklin once said, "An investment in learning pays the best interest." This is very true. When it comes to investing, nothing more will pay off than educating yourself. The whole reason why I'm making these videos is so that we can learn together about the realities of the stock market so that we're better prepared when we invest. Of course, some people like to experiment before they learn, but this is money we're dealing with. And since money doesn't grow on trees, like my parents always say, it's best that we learn about the stock market to its fullest capacity so that we're 100% sure of the decisions we make and that they're the right decisions to make. So with that being said, let's get into it. First off, we need to know where all the magic happens. It's important to know where stocks are bought and sold and how the process happens, which is why we're going to be looking at stock exchanges. Stock exchanges are markets where stock brokers and traders buy and sell securities. If you don't know what securities are, here's a simplified version. Securities are financial assets that you possess and you can trade for money. Now, how are stocks related to securities? A stock is actually a type of security because once you buy a stock, it becomes an asset that you own and you can trade it for more money and profits. I mean, isn't that the whole point of investing in the stock market? Moving on, there are many stock exchanges that are located throughout the world, but the three main ones that you need to know that are situated in America are NASDAQ, NYSE, and MX, which deals with ETFs, and if you don't know what they are, we're going to be exploring that in a later video. While investing, there are patterns that often pop up, and investors who can analyze these patterns are often more successful with the profits they make. You can think of these patterns as rules that stock investors abide by so that they can maximize their profits and invest more confidently. These rules are known as stock indexes. Now here's a more formal version of what stock indexes are designed to do. Stock indexes measure the stock market, or subsets of the stock market, and this helps investors compare current price levels of stocks with past price levels, and this in turn helps them calculate market performance. Now, I've listed 3 different stock indexes that Americans use in America, and it's the Dow Jones Industrial Average, S&P 500, and the NASDAQ Composite. The Dow Jones Industrial Average shows the price-weighted average of 30 significant stocks listed on the NYSE and NASDAQ. Now you might be wondering, why only 30? Shouldn't there be more? This is because these 30 stocks actually come from America's largest blue chip companies. If you don't know what blue chip companies or what blue chip stocks are, then be sure to listen because we'll be exploring that later in the video. Moving on, the S&P 500 is like the Dow Jones Industrial Average, but this measures 500 large companies listed on America's stock exchange. Finally, the NASDAQ Composite measures everything that's listed on the NASDAQ market, and this tracks more than 3,300 stocks. Now here are some differences between the NASDAQ Composite and the Dow Jones Industrial Average. The Dow Jones contains companies that trade on the NYSE and a couple from the NASDAQ market, which includes Apple, Intel, Microsoft, and Cisco. On the other hand, the NASDAQ Composite only measures market performance on the NASDAQ. Of course, different countries use different stock indexes because we have different currency units. Our second major topic for today is sectors, and this term is actually pretty simple to understand. Market sectors describe parts of the economy, so you can consider them as industries that categorize each business as they enter and trade in the stock market. There are 11 major sectors that make up the stock market, and most of these sectors are pretty self-explanatory. I've listed them all right here. I personally think it would be a waste of time if I just talked about these sectors individually, and I understand that you guys don't have the patience nor the time to listen to me talk about sectors for the next 10 minutes. So instead, I'm going to be focusing on a few of the sectors and talking about how to choose stocks based on your preferences. Let's just start off with the financial sector. The financial sector includes banks, investment funds, insurance companies, and real estate firms, among others. In general, the majority of the revenue that's generated by this sector comes from mortgages and loans that gain value as interest rates rise. A popular stock that falls under this sector is Goldman Sachs. Another popular sector that people just gravitate towards is the healthcare sector. The healthcare sector includes biotech companies, hospital management firms, medical device manufacturers, and many other medical-related companies. The final sector I'll be talking about today is the tech sector, and electronic manufacturers, software developers, and information tech firms all come under the tech sector. Popular stocks you should be familiar with is Apple and Google, and this all falls under the tech sector. Now, moving away from sectors, I think it's important that you pick stocks from sectors that you're familiar with or have a lot of experience with. Let's just say you work in the medical industry. It's highly recommended that you look at stocks from the healthcare sector because you probably have more knowledge and information about what's going on in that industry as opposed to, let's just say, the financial sector. What I'm trying to say is the more ideas, knowledge, and interest you have in investing in a sector will help you have a better understanding of how that sector works and how profitable stocks will be in that sector. As promised earlier, I'm going to be talking about blue chip stocks because I think it's pretty relevant to what sectors are. So blue chip stocks are stocks that come from companies that have large market caps. If you don't remember what market capitalization is, then be sure to check out my previous video. People usually lean towards stocks that have large market caps or blue chips because they're known for their reliability. They are the indicators that show whether or not a particular sector is reliable or profitable in terms of people making more money. There are many blue chips within each sector, so along with knowing a lot about a particular sector you want to invest in, another tip is to look at, analyze, and potentially invest in the blue chips of a particular sector. Our final topic for today is trading. The reason why I want to talk about this topic is because there's so many people who often confuse trading with investing. But like how I've mentioned that there's differences between stocks and shares in my previous video, there's also differences between trading and investing. So trading is not the same as investing. The main difference between the two is the interval in which a person deals with and owns a specific type of stock. Investing takes a long-term approach to the stock market and often applies to practices such as building retirement accounts. The main goal of investing is to gradually build wealth over an extended period of time through the buying and holding of a stock portfolio. So basically, if you invest, you're buying and holding your stocks for a long period of time. On the other hand, trading involves short-term strategies to maximize returns in a short period of time, for example, a number of days or weeks. Traders usually follow a set of strategies that they acquire through years of practice so that they can take advantage of the fluctuations, also known as the volatility of the stock market. You can actually pick multiple stocks to trade, but only a few to invest in. There's actually a specific type of trading called day trading, which I'm not going to focus on too intensely for today, but you should know that day trading is when a trader buys and sells securities on the same trading day. However, you need to meet the requirement of having at least $25,000 in your trading portfolio, and that only applies to the United States. I'm not sure about other countries. The final topic I'd like to cover for today is the SEC, which stands for the United States Securities Exchange Commission. This is basically a government oversight agency that's responsible for regulating the security markets and protecting its investors. The SEC is relevant because stocks are a type of security, as I've mentioned before, so this rule basically protects its traders and investors from fraudulent activity that's occurring in the stock market. Once again, thank you so much for watching this video. As always, be sure to like, subscribe to my channel Stocks for Teens, and share it with anyone you know. Also, be sure to hit that notification bell so that you get instant reminders whenever my videos update. For our next video, we're going to be looking at more of the technical perspective of the stock market, such as brokers, brokerage firms, stock portfolios, and so much more. So stay tuned. Also, if you have any content or questions that you'd like me to cover in these videos, then be sure to leave it down in the comments below. But if not, see you next time.